completing the accounting cycle. And I will tell you, I don't believe I gave you any homework on doing worksheets, but we'll talk about it anyway. So benefits of worksheets is that it's not something that's a required report. So things that are required, for example, are your income statement, your balance sheet, and the statement of owner's equity, and then also the statement of cash flows. We've talked about all four of those reports. The worksheet is not something that's required, but it's something that you can use. And it aids in the preparation of preparing your financial statements. It also helps to reduce the risk of errors. It links accounts and their adjustments. We've talked about that last week doing the adjusting entries. It helps in preparing interim financial statements. So maybe it's not at the end of the quarter or whatever the period is, but it helps you to know where you're at. So an interim report also shows the effects of proposed transactions. So you can use that to kind of do some what-if analysis there. So the steps to using a worksheet. When a worksheet is used to prepare financial statements, it is constructed at the end of a period before the adjusting process. Preparing the worksheet has 5 steps. Step 1 is the first step in preparing a worksheet is to list the title of every account and its account number that appears on its financial statements. This includes all accounts in the ledger plus any new ones from adjusting entries. The unadjusted balance for each account is then entered in the correct debit or credit column on the unadjusted trial balance column. The totals for these columns must be equal, remember. So remember that our debits and our credits always have to be equal. So now step 2 then is to enter the adjustments in the adjustments column. Step 3 is the adjusted trial balance is prepared by combining the adjustments with the unadjusted balances for each account. Step 4 is this step involves sorting account balances from the adjusted trial balance to their proper financial statement columns. Expenses go to the income statement debit column and revenues to the income statement credit column. Assets and withdrawals go to the balance sheet and statement of owner's equity debit columns. Liabilities and owner's capital go to the balance sheet and the statement of owner's equity credit columns. And then step 5 is that each financial statement column from steps A is totaled. The difference between debit and credit column totals for the income statement column is net income or net loss. This occurs because revenues are entered in the credit column, expenses in the debit column. If the total credit total exceeds the debit total, there's net income. If the debit total exceeds the credit total, then there's a net loss. And so this is an example of a worksheet. Again, a worksheet organizes information used to prepare adjusting entries, financial statements, and closing entries. So we see here we list the accounts, and so they're unadjusted in the green, the debit and credit. Then you have the adjustments, debit, credit, and then you take and figure in to get your adjusted trial balance, and then you take the balances then and sort them based on where they go. So this is something we've kind of hinted to, I believe, earlier, is we've said that there's some things that are temporary accounts and there's some accounts that are considered permanent accounts. So temporary accounts are the only ones that get closed in the closing process. So temporary accounts accumulate data related to one accounting period, be it the month or the quarter or the year, however we do that. They include all income statement accounts, the owner's withdrawal account, and the income summary account. And we'll talk about the income summary account. That's a special kind of account. They are temporary because the accounts are opened at the beginning of the period, used to record transactions and events for that period, and then they're closed at the end of the period. The closing process, again, applies only to temporary accounts. So expenses, revenues, withdrawals, and then the special income summary account that we'll talk about later. You can kind of think of your income summary account as a garbage bag account, and we'll talk about that later, what that means. So then the permanent account is the accounts. They report activities related to one or more future accounting periods. They include assets, liabilities, and the owner's capital account, all balance sheet accounts. Permanent accounts are not closed each period, and they carry forward their balances. So your assets, liabilities, and the owner's capital, those will carry forward each accounting period. So that'll go into the next quarter or the next month or into the next year. Okay, so the closing process. The closing process occurs at the end of an accounting period after financial statements are completed. In the closing process, we, 1, identify accounts for closing, and then 2, record and post the closing balances, and 3, prepare a post-closing trial balance. The closing process has 2 purposes. First, it resets revenue, expense, and withdrawal account balances to 0 at the end of each period, which also updates the owner's capital account for inclusion on the balance sheet. This is done so that these accounts can properly measure income and withdrawals for the next period. Second, it helps summarize a period's revenues and expenses. So now how do we go about actually closing, doing our closing entries? So recording closing entries. Here are the 4 steps we always follow in the closing process. Step 1 is that we close credit balances in revenue accounts to income summary. And again, think about income summary as your garbage bag account. And we'll discuss that as to why that is later. So the first closing entry transfers credit balances in revenue and gain accounts to the income summary account. We bring accounts with credit balances to 0 by debiting them. So you'll debit the account, credit income summary. And so we'll show that in just a minute. And then you'll close debit balances in expense accounts to income summary. The second closing entry transfers debit balances in expenses and losses accounts to the income summary account. We bring expense accounts debit balances to 0 by crediting them. So you would debit income summary then, and then you would credit whatever the account is. With the balance of 0, these accounts are ready to record expenses then into the next period. Now, step 3 is we close income summary to the owner's capital. So after steps 1 and 2, the balance of income summary is equal to the period's net income, or could be loss, but still the net income. The third closing entry transfers the balance of the income summary account to the capital account. This account closes the income summary account. So this is then we take out that garbage bag to the trash. It closes out the income summary account. The income summary account has a 0 balance after posting this entry. It continues to have a 0 balance until the closing process again occurs for the next accounting period. If a net loss occurred because expense exceed revenue, the third entry is reversed. Debit. So yeah, in that case, you would have to debit owner capital and credit the income summary. But in this case, usually you have should be in the positive. And then step 4 is to close the withdrawals account to owner's capital. The fourth closing entry transfers any debit balance in the withdrawals account to the owner's capital account. So this is how we take care of then what the owner took out and how we recognize that. This entry gives the withdrawals account a 0 balance, and the account is now ready to record next period's withdrawals. Let's see how this process works. To prevent confusion, when we first try to make closing entries, it's an excellent idea to follow these 4 steps exactly. So the first step then we want to do is we're going to close the credit balances and revenue accounts to income summary. So the first closing entry transfers credit balances in revenue and gain accounts to the income summary account. We bring accounts with credit balances to 0 by debiting them. The $8,150 credit entry to income summary equals total revenue for the period, step 1. So we see here that we have a balance, consulting revenue and rental revenue. We take that normally would be a credit balance, but then we debit it in order to close it out, but then we transfer that over here to the income summary as a credit. Okay, so could we debit the account and then credit income summary? Okay, so that's recognizes then our revenue. Now the second step over here is dealing with our expense accounts. So we close the debit balances in expense accounts to income summary. The second closing entry transfers debit balances and expenses and loss accounts to the income summary account. We bring expense accounts debit balances to 0 by crediting them. With a balance of 0, these accounts are ready to transfer the accumulated expenses to the next period. And so in the example that we're looking at on the screen, total expenses for Fast Forward are $4,365. So we see here that normally expense accounts have a debit balance, but then we will credit. So what you'll do is you'll debit income summary for the total, and then you'll credit then each individual account. Okay, which again you'll see. Now step 3 is to close the income summary account to owner's capital. So we see that here. So after steps 1 and 2, the balance of income summary is equal to the period's net income. So in our example we see $3,785, and so that is $8,150 credit less $4,365 debit for Fast Forward. The third closing entry transfers the balance of the income summary account to the capital account. This entry closes the income summary account. If a net loss occurred because expenses exceeded revenues, the third entry is reversed. Okay, so you would debit the owner's capital and credit the income summary. But in this case, we'll do as follows. So we take the debit balance here, which is how much would be, or the balance, we would take the balance, and so the difference between the credit and the debit equals $3,785. That is the net income. So we take that, we'll debit income summary, and then we can credit C. Taylor Capital. So we add that to what the $30,000 was his initial investment. We add that, and so then that gives us $33,785, but we subtract, which will subtract step 4, then that'll give us the ending balance of capital. So we'll talk about step 4 now, is to close the withdrawals account to the owner's capital. So we see here C. Taylor Withdrawals had a debit for $2,000, and so then we'll go ahead and credit that. So we'll debit C. Taylor Capital $200, and then we'll credit C. Taylor Withdrawals, and then that zeroes that out. And then that gives us how much capital we should have. Post-closing trial balance. So after all 4 of our closing entries have been made, we prepare a post-closing trial balance. A post-closing trial balance is a list of permanent accounts and their balances after all closing entries have been journalized and posted. It lists the balances for all accounts not closed. These accounts comprise a company's assets, liabilities, and equity, which are identical to those on the balance sheet. A post-closing trial balance verifies that One, that the total debits equal total credits for permanent accounts, and two, that all temporary accounts now have zero balances. The post-closing trial balance usually is the last step in the accounting process. So fast forward's post-closing trial balance is shown on this slide. The post-closing trial balance usually is the last step of the accounting process. And so we see here that we have all the assets, and then we have the depreciation for equipment, we have our liabilities, and then we have our equity. And then we see here that they both equal out to be the same amount. Knowing that, then we know that we've closed out all of our temporary accounts, and we know then that everything is correct. So then we're ready then to go ahead then and start and go into that next period. Okay, so now the accounting cycle. The accounting cycle is the steps in preparing financial statements. It is called a cycle because the steps are repeated each accounting period. There are 10 steps in the cycle, which include analyze transactions to prepare for journalizing, and then we can journalize, record accounts, including debits and credits in a journal, post, transfer debits and credits from the journal to the ledger. 4, prepare unadjusted trial balance, summarize unadjusted ledger accounts and amounts, adjust, record adjustments to bring account balances up to date, journalize and post adjustments, prepare adjusted trial balance, summarize adjusted ledger accounts and amounts, prepare statements, use journalized trial balance to prepare financial statements, close accounts, journalize and post entries to close accounts. 9 is to prepare post-closing trial balance that tests clerical accuracy of the closing process. And then 10, which is optional, is to reverse certain adjustments in the next period, and that's an optional step. Note that we prepare the financial statements before we complete the closing process. So you'll prepare your financial statements, notice in step 7 first. Once you've done that, then you can go ahead and close out your accounts. Okay, so I know we've talked a little bit about balance sheets before, but we're going to show you now what they call a classified balance sheet. And I believe on the problems you might have one of these that you'll do, possibly. So a classified balance sheet analyzes assets and liabilities into subgroups that provide more information to decision makers. So you organize it by subgroups. A classified balance sheet is the most popular format used by business. On the asset side of the balance sheet, we group assets as current and non-current. And so I know we haven't talked about this. This is the first time that we're talking now about what a current and a non-current asset is. So a current asset is one that is expected to be converted into cash in 1 year or less, or in the company's normal operating cycle, whichever is longer. And so the operating cycle of a company is the time it takes to acquire inventory, sell the inventory, and to collect cash. Most operating cycles are less than 1 year, which means that most companies use a 1 year period in deciding what assets and liabilities are current. These companies will classify an asset as current as long as the asset is expected to be converted into cash within 1 year. And so, for example, supplies usually are a current asset, cash is a current asset, accounts payable would be a current liability. Okay. Then there's some that would be long-term assets, non-current assets. So, for example, long-term investments, plant assets, intangible assets, equity, Notes payable, if it's going to be a note that you're going to pay longer than a year, those would be non-current liabilities, non-current assets. Now on the liability side, plus equity side of the balance sheet, we divide liabilities between current and non-current, which we use the same thing. So a current liability is one we expect to be paid out of the company's current assets within the longer of 1 year or the normal operating cycle. Let's see how new classifications appear on the balance sheet. All right, so a classified balance sheet organizes assets. Okay, that's weird. Okay, so they're just saying the same thing. But you see here, this is an example of a classified balance sheet, and this is for a company called Snowboarding Components. And so we see here the current assets, and so that would include cash, short-term investment, accounts receivable, merchandise inventory, prepaid expenses. So that those are all current assets. And then long-term investments, which would be assets, would include notes receivable due within 3 years, investments in stocks and bonds, land held for future expansion. So those would be non-current assets. And then you have plant assets, so their equipment and building, less the accumulated depreciation, and then land, and then that, and then intangible assets. We'll talk about those later, what an intangible asset is. So that would be, and then liabilities, then current liabilities would be, again, accounts payable, wages payable, notes payable but due within 1 year, the current position of long-term liabilities. So that would be the current liabilities. You could have longer-term liabilities, which could be, again, if it was a note that would be payable longer than a year. And then you have the equity, of course, like we normally do, so T-Hawk Capital. Now, current assets, current assets are cash and other resources that are expected to come due, be collected within 1 year of the company's operating cycle, whichever is longer. Again, examples, as we've said, are cash, short-term investment, accounts receivable, short-term notes receivable, goods for sale, which would be merchandise or inventory, and prepaid expenses. Long-term or non-current investments. Notes receivable and investments include stocks and bonds, are long-term assets which are expected to be held for more than the longer of 1 year or the operating cycle. Land held for future expansion is a long-term investment because it's not used in operations. And then plant assets are tangible assets that are both long-lived and used to produce or sell products or services. Examples would be equipment, machinery, buildings, and land that are used to produce and sell products and services. Plant assets are normally listed in order of how quickly they can be converted to cash. And then intangible assets are long-term assets that benefit company operations, but they usually lack physical form. Examples would be patents, trademarks, copyrights, franchises, and goodwill. The value comes from the privilege or right granted to or held by the owner. So, for example, the patents, that's dealing with the things that the company creates. So they have patents that protect the product. So, for example, I have a friend that she makes purses that you put your cell phone in, and so you don't actually have to take your cell phone out in order to use it, like to use the screen on it. And it's called Save the Girls Purses because obviously, you know, they sometimes put them in other places to otherwise if they don't have a way to do it. So anyway, a patent, then, if she developed this thing, she has a patent on it. That means that nobody else can legally create a purse that's the same way. So that's a patent. A trademark would be something protects the name. So, for example, Save the Girls, that is a trademark. No one else can use her name or the colors or the logo, etc. Copyrights, that would be, for example, our book is copyrighted. I can't freely make copies of the book. Franchises, for example, McDonald's, they're franchises, so people purchase the right in order to run those. So they're independently owned and operated, but they have to run it a certain way. And then goodwill comes with the good reputation of the company. So those all have value, and so those would all be examples of intangible assets. Because I know we haven't talked about that yet. Now, current liabilities. Current liabilities are liabilities that are due to be paid or settled within 1 year or the operating cycle, whichever is longer. They're usually settled by paying out cash. Current liabilities often include accounts payable, notes payable, wages payable, taxes payable, interest payable, and unearned revenues. They also, any portion of a long-term liability that's due to be paid within 1 year or the operating cycle, whichever is longer, is a current liability. So for example, maybe you have a mortgage on the building that you use for your business, and maybe it's a 30-year mortgage. Well, the portion of that you would pay within that operating cycle, that would be the current portion of it, not the entire thing. Unearned revenue are current liabilities when they are settled by delivering products and services within 1 year or the operating cycle, whichever is less. Current liabilities are reported in the order of those to be settled first. Yes.
Are credit cards considered current liabilities, or they're like long-term because
it'd be a current liability. We hope that we would pay them off within 1 year.
Oh, okay.
Now, I know that like individuals, unfortunately, we carry them more than a year. But yeah, normally it would be a current asset. Usually a business, if they use a credit card, a lot of times what they'll do, they'll use it, but then they'll pay it off that month. Usually. Okay. They just use it because it's easier for them to keep track of if their people are out, like their managers and stuff. If they're out, it's easier for them to have a credit card, a company credit card, than it is for them to have like a checkbook or something. And then at the end, when the bill comes, then the company usually just pays it off. But that would be an example of a current liability. So, very good question. All right. Long-term liabilities. Long-term liabilities are liabilities that are not due within 1 year or the operating cycle, whichever is longer. Notes payable, mortgages payable, we've talked about that. Bonds payable, because some companies will sell bonds, or government agencies, they'll also do that, they'll sell bonds. And then lease obligations are common long-term liabilities. If a company has both short and long-term items in each of these categories, they're commonly separated into two accounts in the ledger. So you'd have one account for, let's say, you have notes payable, but that's current. You'd have an account for that, and you'd have an account for the portion of that that is a non-current asset. And then equity is the owner's claim on assets. For a proprietorship, this claim is reported in the equity section with the owner's capital account. And then moving kind of right along is the current ratio. So we can use the current ratio in order to assess the company's ability to pay its debts in the near future. So an important use of financial statements is to help assess a company's ability to pay its debts in the near future. Such analysis affects decisions by suppliers when allowing a company to buy on credit. It also affects decisions by creditors when lending money to the company, including loan terms such as the interest rate and the due date. The current ratio is one measure of the company's ability to pay its short-term obligations. It is defined above as current assets divided by current liabilities. And then we'll show an example there. So Costco's current ratio for each of the last 3 years is shown in Exhibit 411. A current ratio of over 1 means that the current obligations can be covered with current assets. For the recent 2 years, Costco's current ratio was slightly below 1. This means Costco could face challenges in covering liabilities. Although Costco has a better ratio than Walmart in each of the last 3 years, management must continue to monitor current assets and liabilities. And so we see the red current ratio, that is Costco for the current year, a year ago, and then 2 years ago. And then we see Walmart, which is in black. So we see that Walmart is struggling in order to make that. And it could be just because Walmart, maybe they're in an expansion mode, or they're doing some other things that taking on a little bit more debt. So now this part is an optional part, but we'll go ahead and discuss it. So it's reversing entries. Reversing entries are optional. They're recorded in response to accrued assets and accrued liabilities that were created by adjusting entries at the end of the reporting period. The purpose of reversing entries is to simplify a company's bookkeeping. Let's see how accounting for the payroll accrual will be handled with and without reversing entries. So the purpose of reversing entries is to simplify a company's record keeping. This slide shows an example of fast forwards reversing entries. The top of the exhibit shows the adjusted entry fast forward recorded on December 31st for its employees' earned but unpaid salary. The entry recorded 3 days of salary of $210, which increased December's total salary expense to $1,610. The entry also recognized a liability of $210. The expense is reported on December's income statement. The expense account is then closed. The ledger for January 1, 2018 shows a $210 liability and a zero balance in the salaries expense account. At this point, the choice is made between using or not using reversing entries. So now, accounting without reversing entries. The path down the left side is described in the chapter. So it's what we've been talking about. So to summarize here, when the next payday occurs on January the 9th, we record payment with a compound entry that debits both the expense and liability accounts and credits cash. Posting this entry creates a $490 balance in the expense account and reduces the liability account balance to zero, because now the payable has been settled, because we've now paid the portion that was owed from what they did in the very end of December. So we see here that you have a debit for salaries expense, $490, and you have a debit for accounts payable, $210, cash for $700. So we see here that you have, for December 31st, you had a credit of $210. That's the balance salaries payable, because we owed that to them from the work that they did in December. And then when payday comes around on January the 9th, we will debit the current portion. So for the days that they worked, the pay for the days that they worked in January, $490. And then we also will debit the $210, which was what they, in salaries payable, which was what they were owed from December. And then you'll pay cash $700, because that's the total for both of those, and that's what you're paying to your employees. So now, accounting with reversing entries. So the left-hand side is what we've been discussing, but you could also do with reversing entries. So the right side shows reversing entries. A reversing entry is the exact opposite of an adjusting entry. So for fast forward, the salaries payable liability account is debited for $210, meaning that this account now has a zero balance after the entry on January 1 is posted. The salaries payable account temporarily understates the liability, but this is not a problem since the financial statements are not prepared before the liability is settled on January 9th. The credit to the salaries expense account is unusual because it gives the account an abnormal credit balance. It should not have a credit balance, it should have a debit balance. We highlight an abnormal balance by circling it. Because of the reversing entry, the January 9th entry to record payment debits the salary expense account and credits cash for the full $700 paid. It is the same as all other entries made to record 10 days salary for the employee. Notice that after the payment entry is posted, the salaries expense account has a $490 balance that reflects 7 days of salary at $70 a day. So again, a portion of it that they would have earned in January. The zero balance in the salaries payable account is now correct. The lower section shows that the expense and liability accounts are exactly the same balances, whether reversing entries are used or not. And so we see here that on December 31st for salaries payable, we had a credit of $210 because that was a liability that we had. And then January the 1st, we went ahead and debited that $210 and we credited the salaries expense $210. And we normally wouldn't credit salaries expense, so again, we circle it because that's an abnormal balance. And then when we go ahead and do the payroll then for January the 9th, then we would just go ahead and record the amount that we normally would have paid for both what they worked in December and then what they worked in January, $700, which would be a debit. So we subtract 210 from 700, that gives us 490, which is the correct balance in that account. And then if we look here, we see then that the salaries expense is 490, and then we see here that the salaries payable is zero at this point because we now have paid the portion that they were due from December. So now it works out the same no matter what, either way that you were to do it.